Hi, this is Mike Wise with Mortgage Wise at Capstone Direct Mortgage, and today we're going to be talking about 1031 exchanges. And we've got Greg Burns from IPX Exchange, where he just does 1031 exchanges. So thank you for being here. I appreciate it.
Yeah, thanks for having me.
Awesome. So he's been doing this. He's a senior vice president over there. He's been doing it for over 20 years. So he probably has a little bit of knowledge that you and I don't even have. So we're gonna start off with some of the basics here. So the 1031 exchange is for that investor that's out there, or just that regular borrower that's out there, like they hear 1031 exchange, but they don't really know what it is. So give me a basic rundown of what a 1031 exchange is.
So 1031 is a section of the tax code which allows someone that owns property they've held for investment or business use to sell that property and buy another property that they intend to hold for investment or business use and defer the taxes from the sale of that property into the new replacement property. So it's a way that you can take money that you would have normally paid in taxes and use it to go make more money with.
Okay, so that's really simple. So if I even broke it down even further, I own a investment property and I go to sell that property, and if I didn't do a 1031 exchange, whatever gain I had on that property, I would pay income taxes on.
Yeah, so capital gains taxes. So the idea behind 1031 is that when you sell investment property, there are typically long-term capital gains taxes on properties that you've held for 12 months or more. And the idea behind 1031 is you can take that and defer them into the next property. They're not tax-free exchanges, so the taxes are still there. In fact, I had a client call me a couple weeks ago, and she did an exchange with us about a year ago, and she said, hey, I sold this property and did an exchange with you about a year ago. I own the property now, and I want to know how long I have to hold it before I can sell it. And I said, well, you could sell it anytime you want. Do you want to do another exchange? And she said, no, I just want to cash out. And I said, well, you sell it anytime you want. And she said, why would they let you do that? And I said, why would they let you do what? She said, why would they let you do an exchange, buy this new property, and then sell it and not pay any taxes?
Oh, no.
And I said, I didn't say anything about not paying any taxes. The taxes are still there, right? You just deferred them into the next property, which kind of leads to the next thing, which is some people say, well, why should I do an exchange? Like, why, if I'm going to ultimately have to pay
for those taxes
somewhere down the road, why do an exchange? Well, the idea is that if you're in the business or you're a real estate investor, keeping your money in the real estate market, especially we've seen the last 20 years that I've been in the business, it really grows your portfolio. And so the more money you can keep in the market, the more you can kind of grow your portfolio.
Interesting. So, I mean, basically in her scenario, she's like, oh, I want my money now and I don't want to pay any taxes. But the reality is that at some point in time, you're going to pay the taxes, but you can choose when you pay those taxes when you sell the property.
Right. They say there's two things in life that you can't avoid, right? Death and taxes.
Yep.
But you can avoid some taxes by dying. We call it the swap till you drop program. So you exchange throughout your lifetime, and then when you pass away, your heirs receive a step up in basis equal to the fair market value at the time of death. And so it basically eliminates capital gains taxes. And in a state like California, where it's a community property state, your spouse could receive a full step up in basis. So it's really a good estate planning tool that you can use as well.
So it's more of a long-term play in real estate at that point in time. So what are there any requirements for a 1031 exchange? So just my basic knowledge, I hear like for like properties.
Right.
Like what are what is that? And then what are some of the other kind of qualifications that you have to have for the 1031 exchange?
So if you look at the basic definition, right? So you go, okay, it's got to be a property held for investment or business use, right? So properties that are held primarily for sale don't qualify under Section 1031. And the reason that they put that in the tax code is because they didn't want to see developers or flippers doing exchanges, right? Those are people that are really buying the property with the intent of holding them primarily for sale, right?
Yep.
And then it brings you kind of to the like-kind rules, right? So it's really kind of a misnomer because people think, what's like-kind, right? So like, if I own a single-family residence that was a rental, what's like-kind with that? Well, probably another single-family rental. In fact, I got a call from a CPA, from a client who talked to their CPA. They own vacant land. They wanted to sell the vacant land and exchange it for this 4-unit deal that they saw in San Luis. but their CPA said you can't exchange vacant land for improved property, which is absolutely not true,
Yeah.
right? So the vacant land is real estate, right?
Yeah.
They've held it for investment or business use. The fourplex is real estate that they're going to hold
Yeah.
for investment or business use. So it will qualify. So you can exchange, any asset class of real estate as long as it's been held for investment or business use for any other class of investment real estate.
The like for like is kind of like a real general term in real estate at this point in time. What about that? Maybe it's not even real estate, like a restaurant or a business or something like that. Can you do it a 1031 exchange there?
You used to be able to exchange personal property, and that's where the like-kind rules became really restrictive.
Okay.
But now it only applies for real estate. When they came out with the 2017 tax reform, in that deal, they eliminated 1031 for personal property. In fact, before that revenue procedure came out, I had exchanged all kinds of things. I had exchanged farming equipment, tugboats, railroad cars, exotic cars, artwork. In fact, the running joke in my office was that I had figured out how to exchange everything with the exception of husbands and wives.
The tax ramifications on that
Could be significant, right?
Yeah. That's awesome. Awesome. Well, so let's talk about timing of a 1031 exchange. So if I own an investment property and I sold it today, is there a timing factor that I have to buy the next property with the funds of the sale of that property?
Yeah. So the timing rules are, you've got 45 days from the date that escrow closes to identify the property that you want to purchase, right?
Okay.
And that's probably the hardest part of the exchange process, is locating that property in that short amount of time. And then you've got another 135 days after that to buy one of those identified properties. And so it's a total of 180 days. I used to tell clients you have 45 days to identify and a total of 180 days to close. And then what they would do is add 45 to 180, come up with like 225 days. I'm like, you don't have 225.
180.
Yeah, so 45 plus 135, a total of 180 days.
Okay, and what happens if you don't do it within that prescribed time?
So typically you have a failed exchange. Currently in California, there's been a disaster relief notice that happened. Actually, it started in January. And so what it did was it extended time deadlines out to May 15th because of the flooding that was happening in California. In fact, almost every county in California was included in that IRS disaster relief notice.
Interesting.
So it provided some relief to taxpayers who are currently in exchanges. Because of this storm, they've now extended those deadlines from May 15th out to October 16th. So they've really extended some time deadlines. But for the most part, if you don't identify a property in 45 days or you can't close within that 180-day period, you have what's called a failed exchange, and you got to pay your taxes. I mean, it's a terrible story, especially coming from the exchange guy. But I was in an exchange last year. I was going to buy an industrial building, and my best friend is a lender, does construction loans, and he said, you have to get an environmental report, a phase 1, on the property before you buy it. You can't do it. It's industrial. You've got to do it. I said, I don't need it. The seller's going to carry back a note. There's no requirement that I do it. He said, you have to do it. So I said, okay. So I did the phase 1, the environmental report, and it came back and said, you need a phase 2.
Oh, yeah.
Well, the environmental report took like 30 days, right? So I went under contract like the first week into my exchange. So 30 days in, I'm about 35 or 36 days into my exchange. I've got about 10 days before the 45 days is up. And so I go back to the seller and the brokers the broker was a friend of mine. Sellers were very nice people. And I said, listen, I'm gonna have to just bail on this deal because I don't have time to do a phase 2. It takes like 45 days to get those done, and they are very expensive. In fact, for this little industrial deal, it was like $17,000.
Yeah, you're like, no.
And so the sellers, very nice people, said, listen, we'll pay for it. And I said, okay, here's the deal. If you pay for it, as long as it comes back clean, I'll pay for half. So 45 days goes by, the report comes out. It doesn't even give me like a remediation plan, like something to like how to clean it up.
Yeah.
It's so bad, it just says consult your attorney. And so obviously at that point I couldn't buy it, but I was past my 45 days. It was the only property that I had identified. So then, unfortunately, the exchange guy had a failed exchange, which is a little bit embarrassing, but it does happen.
How many properties can you identify that you may be purchasing?
Yeah, so that's a great question. So there's three actual rules that are under Section 1031 on how to identify property. There's two basic rules that people use. Most people in an exchange are selling one property and buying one property, but the code doesn't say you have to sell one and buy one. It just says you have to sell investment real estate and buy investment or business use real estate. So you could sell one property, buy multiple properties. You could sell multiple properties, buy one. And so the identification rules there's a 3-property rule, which allows you to identify 3 properties. And then under that, the value of those 3 properties doesn't matter. It just limits the number you can identify. Then there's a 200% rule, which says, listen, we'll allow you to identify as many properties as you want, as long as the total aggregate value is not more than twice the value of the property you sold. So if I sell a property, let's say for $1 million, I could identify up to $2 million worth of real estate. And that could be 10 $200,000 houses in Arkansas or whatever.
And that's within the first 45 days of that, right?
Yeah, so you don't have to identify till the 45th day. So when clients are, out in their exchange, maybe they're in their 45 days, they can make as many offers as they want. They don't have to identify those properties. But once they get to the 45th day, they've got to identify property. And once they're on day 46, they're married to those whatever on that sheet.
They are married to us. That was my next question. Is like, okay, we like that property, we identified it, and then it falls out. Can you close on another deal within 180 days? Another property that's not on the list?
Yeah, you can. You're kind of stuck with what's ever on that list.
That's so rough.
Yeah, and so but it does force people to get past certain things. Like I had a client one time. He was under contract to buy a house in Dana Point down in Orange County for $3.8 million. And he called me up and he said he was past his 45 days. He'd only identified that property. He said, you know what? That the house is supposed to have these GFI switches, doesn't have them. I'm going to blow out of this deal because the seller's unwilling to pay for it. And I said, well, how much is that going to cost? He said, it's like $3,500.
Yeah,
I'm like,
your taxes.
Maybe call your CPA and talk to them about what you're going to pay in taxes. So before you make any decisions. So he called me up 15 minutes later and he goes, yeah, my tax liability is like $700,000, so I'm going to go ahead and pay the $3,500. He's like, but the seller still should pay for it. But I'm like, I get it.
Yeah, that's a principal thing that, you can't get around some of those things, right. But you have to make the right choice. And consulting you and your CPA as a borrower are super important to do those things, right?
Yeah, I mean, we can provide the client with a lot of tax information on 1031, but there are certainly gray areas when it comes to 1031. And we also always want to get the tax advisor involved to make sure that they understand what's going on.
Tell me, I know this is kind of going to the next level, but what is, I've heard reverse 1031 exchanges.
Oh, that's crazy. All right.
Yeah, let's go.
So reverse exchanges actually become very popular in the past, I would say 2 years. And the reason was because there was such limited inventory. There was so many buyers chasing deals that people were concerned hey, I know I can sell my property, but I'm concerned that I'm gonna not be able to buy one, which was a very legitimate concern in the market that we were in. And
still is today.
Today's market, right? Yeah. So we saw inventory levels kind of creep up and then they started to come down. And now, because of the limited inventory, you really have, still a challenge with buyers. I mean, it's still tough to find property.
Yep.
And so the reverse exchange, what it does is it allows someone to buy the property that they want before they sell the property that they have. The challenge is that we actually have to take title to the property that they're buying because they can't be on title to both properties at the same time. And we do so in an LLC. Now on commercial deals, not as challenging, but on residential deals, it's challenging to get lenders to find them, and you can talk to this, that are willing to lend to an LLC on a residential deal.
They're not easy to find for sure. I don't do them, but there are people out there that do lend on to LLCs. And sometimes you might get into a hard money transaction which at that point in time is going to be a higher interest rate, fees, and so forth. So, but I'm sure that you know a few lenders out there that would lend to them.
There's not a lot. I can be honest with you. There's not a ton of them out there that are willing to do it on residential. On commercial, it's not as big of a deal because they're used to lending to LLCs.
Yeah.
But residential, typically they securitize the loans and cut them up, and so they want an actual person on the hook for the loan. Now, we certainly see lots of people that transfer the properties into LLCs after they've purchased them for liability purposes. But typically, when you're trying to get a loan. So when I tell clients, if they're going to do a reverse on residential property, typically they're going to almost have to be all cash.
I'm going to circle back to what we just talked about, just to make sure that they know what we're talking about here is that. So a reverse 1031 exchange is actually buying the property today that you want. So you've identified that property, and not only have you identified it, you purchased it, right? But now you have to sell your other property.
Right.
And so when you create this reverse 1031 exchange, you create an LLC to put the purchased property into that LLC.
That's right.
Right? So that LLC is created to basically hold title to that property because you can't hold title to that property and your property that you're selling at the same time, right? Okay, so now I'm going to go one step further. When you sell this property, your existing property, you are going to pay the LLC.
Yeah, so the LLC is exactly what you're saying. It's called an exchange accommodation title holder.
Yeah.
So it's a title holder to the real estate. Once we close on the real estate, we triple net lease it back to the customer, which means we give them basically all the ownership of the property. They collect rents, they keep the insurance. We just act as a title holding entity.
Yeah.
Once we close, they then have a flip-flop of a regular exchange. They have 45 days to identify the property that they want to sell, which typically is pretty easy.
Yeah.
Then they've got another 135 or a total of 180 days to get it sold. Once the property they're selling goes under contract and into escrow, we assign into that transaction like a regular exchange. So when that sale closes, the money comes over to us, and we use that money to pay the client back the money they loaned the LLC to buy this property. And then to try to get away from getting hit with double transfer taxes, we give them 100% interest in the LLC. So we do an entity transfer opposed to a property transfer.
Don't do this on your own at home. It gets really complicated, right? So there's some things that we don't, the people that are doing the exchange, they may or may not do them on a regular basis. And so it can get very technical in how these things work out. And you want to make sure you follow the rules.
Yeah, I mean, so reverse exchanges definitely from our standpoint are more challenging, right? But from the customer standpoint, A, they've got to have the money to do it, so they've got to be able to, come up with the money to buy the property without selling the one that they have. And B, the reverse exchanges are a more expensive type of an exchange. But when somebody's looking at, significant tax liability, the fee to do the reverse is not really that significant.
No, right. So let's talk about. This is a little bit off topic of what the questions that I gave you beforehand, but it's in my world of residential lending. Fannie Mae, Freddie Mac, or the entity that kind of runs them is the FHFA, and they are changing the guidelines around and pricing around to discourage second homes, discourage investment properties. Are you seeing that from your side of things on the 1031 exchange? Like, is the government trying to, because of the housing shortage, are you seeing less 1031 exchanges, or are you seeing more 1031 exchanges?
I think the market is dictated right now that we're seeing less than we did before, just because of market conditions. And 1031 is one of the things that's kind of always been on the chopping block with the government.
Right.
They go, okay, hey, like $70 billion of exchanges were deferred last year. Let's do away with 1031. We'll generate $70 billion, right?
Yeah.
And so, really since the Obama administration, they tried to limit 1031s to like $1 million a year, was his suggestion, that you could defer in taxes. And then interestingly enough, when Trump came into office, they talked about replacing 1031 with something called immediate expensing, which was interesting because it created a huge lock-in effect because you could take 100% of the improvement value of a property and expense it in a single year, opposed to depreciating it out over 27 and a half.
Right, yeah.
Right, and so we, kind of did a lot of lobbying for 1031. We had economic studies done, and ultimately what we found in our last economic studies that we had kind of updated, we had one done by these economic professors, Ling and Petrova. We had one done by the CPA firm Ernst & Young.
Yep.
And basically what they kind of came up with, they said, okay, if you do away or severely limit 1031, you're going to raise about $19.8 billion over the course of the next 10 years. So a little more than $2 billion a year. But you are going to shrink GDP by almost 56 billion because all of the people that get paid in real estate transactions are no longer going to be getting paid and are no longer going to be paying taxes.
Interesting.
And so the House Ways and Means Committee, the president of my company, our former general counsel, and the FEA, which is a kind of the governing body that oversees exchange companies, they have done a lot of work with our elected officials to make sure that they understand that 1031 is good for the real estate economy. It allows people to move within real estate investments, and it really generates, tax revenue for local governments. Because when you do an exchange, let's say in California, let's say you bought a house 10 years ago for $500,000. Today it's worth $1 million.
Yeah.
Well, you're paying property taxes in California at the lower rate, right?
Yeah.
If you do an exchange and you sell that asset, right? The new person that comes in buys it for $1 million. They're going to pay property taxes at $1 million.
Right.
There's going to be transfers taxes that get paid to the local government.
Yeah.
And then when I do an exchange, right, and we'll talk about the reinvestment rules, I'm going to go buy a new property for probably $1 million or more, and I'm also going to have to pay property taxes at a higher level.
Yep. Yeah.
So it really kind of benefits, local governments, and from a tax perspective, and it's really kind of a beneficial code that's really been around for almost 100 years.
I do have borrowers calling me up and saying, hey, I am doing a 1031 exchange. I'm going to go buy this other property. And so I said, great, we can do that for you. Here's what the rates are. And so when I tell them the rates, they're like, wait, what? And because I'm quoting them investment property rates, right? And those are a little bit higher.
Yeah.
And so they come to me and they're like, well, I'm going to live there in a couple of years. Can I do it with owner occupied rates? And I'm like, no, because you're doing a 1031 exchange. So from a financing perspective, do you get that same issue on your side? And what are the rules? Like if, I think we talked about it a little bit earlier, but basically if my kids were to rent that property as an investment property, how does that play into things?
So we do see a lot of that going on right now. So let's face it, real estate prices have gotten insanely expensive, right?
Yep.
I have 4 kids, and I think about how are they ever going to afford to be able to buy a home, right? Especially in California. And so we are seeing some investors that are selling investment property. In fact, I just had a client do it, sold some property in Tennessee. It was actually a pretty large sale, and bought a property here in California for his daughter to live in. The daughter's got to pay him fair market rent for the property, right? Okay. He's got to get an investment loan, right? Because it's an investment property for him. And it kind of brings me up to kind of a good point, which is we do have clients that will, say, hey, does it matter if I, show this as a second home to the lender? Does it matter what kind of loan I get? And I always tell them that typically, if you aren't honest about like, hey, it's a second home or it's going to be my primary home, when it gets to the underwriter, what happens?
It's going to be an investment property.
Right, because then they see that language in the contract saying it's a 1031, or they see our exchange language in there, and they realize, okay, it's an investment property, right? Yep. And so the lending criteria for investment property, not only the rates are different, but the way that you can lend on it, right, is different.
Yep. Yeah.
And I really kind of learned that a couple years back when I was buying an investment property, and they were looking at the income of the property's ability to repay the loan and to make the payments on the loan. And I was like, well, no, you got to look at me. I'm the one that's getting the loan. They're like, no, that's not the way it works, right? So it's kind of a different deal.
Yeah.
But we do have clients that are buying properties that their kids ultimately are living in, as long as the child pays fair market rent. Now, there's an interesting thing that came up kind of with this particular case was, he said, my daughter can't afford to pay fair market rent. And so their CPA took the position of, well, you can pay your daughter a management fee for managing the property that they live in,
Right, yeah.
a caretaker fee. And so because of that, it kind of was able to bring down her rent a little bit.
Yeah.
But we do see a lot of people doing that. We do see a lot of people, doing that type of stuff.
Go one step further here is that if I have a rental property here and I buy I exchange it for a property in Tennessee, so
Yep.
go backwards,
Yep.
right? So we're buying in Tennessee, I rent it out. How long does it have to be rented out for before I actually move back there and occupy that residence?
Yeah, so it's a great question. And so the rules say that you've got to hold the property as an investment. There's a revenue ruling that says you've got to hold it as an investment for 2 years or more. And if you've held it for 2 years as an investment, there's a revenue procedure that says in an audit, they can't challenge the held for investment portion of the exchange. So as long as you hold it as an investment for at least 2 years, after that, you can kind of do whatever you want.
So basically 2 years of tax returns have got to show it as an investment property.
Right.
Once you're done with that, then it's fair game after that. And then if you sold that property, you're going to pay the capital gains tax on it anyways.
Right. And so a lot of people ask, like, do I have to rent it out full time? Can I do part-time rentals like VRBO or Airbnb? Certainly those qualify. You could hold it as a vacation investment property. And they'll say, well, can I spend any time there? And I say, well, the rules say that you can't spend any more than 14 days a year there for personal use. Now, time that you spend there doing maintenance on the property or improvements doesn't count against your 14 days. So, clients usually in the first couple
Hang
years,
a picture.
they spend a lot of time making improvements on their property. But, so a vacation investment property can qualify as an investment.
Finally, if you were to go 1, 2, 3, 4, 5, what would be the most common mistakes that people make? So even if we've already talked about them, what are the 5 most common mistakes that people make?
So it all goes back to advanced planning, right? So advanced planning is the key to a successful exchange. I would say that the people that typically get into trouble sell their property purely based on price. They go, hey, somebody comes in and goes, listen, I can get you $5 million for your property. They go, I'm gonna sell it. And then they're out there on their 45 days, they're looking for property. They call me up, they say, Greg, I'm really having a tough time finding a property. And I'm like, well, what's the issue? Well, everything out there is just so expensive. And I'm like, well, did you get a lot of money for the property that you sold, right?
Yeah.
They're like, yeah, that's why I sold it. I got so much money for it, I felt like I had to sell it. And I'm like, do you think that no one else's property appreciated right alongside yours, right?
Yeah.
So advanced planning is important, and you should go into the exchange process with, kind of an understanding of what you're trying to accomplish. What goal are you trying to accomplish? When I meet with clients, I work with, a lot of agents, and I'll sit down with investors, and they'll be talking about selling their property, and I'll always ask them, what are you trying to accomplish by selling this property? Are you trying to increase cash flow? Are you trying to do it for geographic reasons? Are you trying to reduce management responsibilities?
Mm-hmm.
What are you trying to do by selling this asset? Because it's important that when you go into it, if you're doing an exchange, you're buying and selling in the same market. You're not going to sell high and buy low. That doesn't really happen, right? Because the timelines are so short that you're really not going to swing into different markets. So you have to go in it with, trying to accomplish a goal. We see a lot of people right now, especially the baby boomer generation, that are going into passive investments. They're buying into these, triple net lease investments. They're buying Starbucks and Walgreens and Dollar Trees and Jack in the Box and Carl's Jr.'s and McDonald's, where that tenant is responsible for the maintenance of the property, the taxes, the insurance, all that stuff.
Yeah.
And they just become a passive owner, right?
Yeah.
And so you're seeing clients that are doing that. You're also seeing clients going into these things called Delaware statutory trusts, where they're kind of passive investments where a sponsor goes out and they go buy, like there was one in Texas where they bought 16 self-storage facilities, and your client could buy a small fractional interest
of that,
in all of those deals. Those DST deals are interesting in the sense that you become a very passive owner. You kind of I equate it to like for your whole life you got to drive the bus, right? And if you wanted to sell or refinance or exchange or all that stuff, you're the ones that make that decision. When you go into those types of investments like a DST, where you're investing alongside a lot of different investors, you become a passenger on the bus. The bus is going to Florida and you can't get off the bus.
Yeah.
It's basically on its way there.
Yeah.
But so advanced planning is important.
Goals.
Lending is very important.
Okay.
Right. So in an exchange, right, the reinvestment rules say that you got to do a couple things. You've got to buy something equal or greater in value to what you sold. Right.
Yeah, okay.
And that's the net sales price after closing costs. So you can back out things like, real estate commissions and escrow fees and title insurance fees. And you also have to reinvest all the proceeds from the sale. But if you had a loan on the property that you're selling, you're typically going to get a loan on the property that you're buying, right?
Yeah.
And so because of that, you need to make sure that you talk to your lender to make sure that you can qualify for that loan. And the criterias, I'm sure have changed a lot, probably in the last 6 months,
Yeah,
right?
they change all the time.
Right, so like I had a client one time, sold this deal for $2.4 million. She had $1.3 million of equity. She went to go buy a new property. She couldn't get financing because she had no way to repay the loan. It was all income from the property.
Yeah.
So it's really important that you talk to a lender, especially like I talked to a client on the way up here saying, hey, you know what? I want to buy a more expensive property. And I said, okay, well, make sure that you talk to a lender about, what kind of property qualifies, how much you can put down, all of that kind of stuff. So if you have to have reserves, right?
Yeah.
So that you are not in a position where you've sold your property, you found one that you want to buy, now you're talking to a lender and the lender says, okay, well, here's the criteria, and you suddenly don't meet it.
Yeah, you can't meet it.
Right.
You can't get a loan, and then you got to pay your taxes.
Right, then you're in trouble. Yeah, then you're in trouble, absolutely.
All right. Anything else that you want to kind of shed light on?
So, I'll talk about our industry a little bit. So our industry, we don't have to be licensed or regulated like you guys are regulated,
Yep.
right? Real estate agents are regulated. Our industry is not regulated. You don't have to be licensed or bonded. So, anybody today could open their own exchange company.
That's scary.
Yeah. So because we're wholly owned by a large title insurance company, Fidelity National Financial, they provide the client with guarantees. We have bonding insurance. So the company that somebody chooses is always important. I always get interesting when I get a phone call from somebody that says, hey, I'm calling you and find out what your pricing is. And I'll tell them what our price is. And then they'll say, okay, thank you. And I'm like, did you not want to know anything else about the company? Like, who you are, who's protecting your money.
Yeah.
Always important.
Yeah. So you don't want some Joe Schmo just doing a 1031 exchange for you that doesn't know all the details and where is that money going to go and so forth. Yes.
Yeah. The other thing is, 1031 is a federal tax code, right? So you can exchange anywhere inside the U.S. Now, California does have what they call a clawback provision, which says that it will allow you to sell a property in the state of California, buy a property in another state, but you still owe the state of California that money if you ever sell that other property, right? So before it was hard to track, right?
Yeah.
So people would sell a property in the state of California, go buy something in Nevada, and then 5 or 6 years later they decide to sell it. People weren't going back to the state of California saying, listen, I know you didn't know this, but I sold this property in Nevada and I'm here to pay you my taxes. So now California does still allow for you to, exchange out of state and defer the California taxes, but they have a filing requirement. It requires you to file something every year with the state of California, making sure that, if you ever sell that asset and just cash out, California wants whatever the gain that you made in California to get paid to them.
So interesting.
Yeah.
Yes. Exit tax almost like they're talking about as well. But
yeah,
yes.
I mean, there's a tax battle going on between California and New York, who can tax their residents the most, right? So California had this clawback provision, then, New York got onto it. And so it's an interesting deal.
Yeah. So that's 1031 exchanges. There was a lot of basic information, and then we got into some of the details. Greg, thanks for coming on. I super appreciate it. And if you want to learn more about 1031 exchanges, you can look up Greg, or you can give me a call and I can give you his information. But this is Mike Wise with Mortgage Wise at Capstone Direct Mortgage. You can follow us on Instagram or YouTube, wherever you please. So look forward to seeing you next time.